Good evening, everyone. I hope my voice is clearly audible and I'm visible as well to all the participants here on the YouTube live. Please give me a quick confirmation over the YouTube chat box. I'm waiting for your confirmation. That's great. Okay. So, welcome you all to the grand revision of financial reporting and strategic business reporting for June 2025 attempt. So, I'm sure all of you who are attending this session, they are kind of well prepared with their concepts, and actually, you are ready for a full-fledged revision of all the IFRSs in this one single video, which are tested in your syllabus. Now, the first part of this particular session I'm going to dedicate to financial reporting. Now, that does not mean that it is not relevant to SBR students, because you all know SBR is just an extension of FR, right? So, you will attend the FR part and then we will build our knowledge forward towards SBR. So, these are both your ACCA exams. And I want all of you to be, seated in a right posture, maybe on a table, not lying down somewhere, and just listening to me very carefully. If you want, you can take running notes along with this lecture, because we are going to just discuss purely the concepts. Okay, I'm going to discuss what is stated in the standard in a simplified way. Now, of course, the application part, its testing part, that's what we all have done in our courses in Super 20 questions, in Kit question debrief section. So we have covered all the application parts already. So this particular session is just going to be for your standards. Now, if anyone is sitting for their interviews, this session is useful for them. If anybody is sitting for AAA, this session is equally important to you, because you all know that in AAA as well, IFRSs are direly needed, right? So let's begin with the session. But before that, let me just give you a few rules of the session. Now, while I am sharing my screen, I'll keep my camera off. Why? Because I want you to focus on the screen itself, right? Just focus on what is being written. So we are going to make a colorful PDF of our notes, which are very crisp, concise notes, which you can refer to one day before the paper. Now, you can only refer to that note if you would have attended the session, because I'm going to use certain, short forms which you might not understand if you just look at the notes. So please bear with me and listen to the session till the end. Plus, if you would have any doubts during the session, make sure that you wait for me to complete that portion. Then I ask you in the chat box, like I'll ask you verbally that if you would have any doubts, please let me know in the chat box. So then you can comment down that, ma'am, this is not clear to me. I will avoid re-explaining something. I'm being very honest here because we have limited time, but a lot of stuff to be covered. Plus, you have an option to, this is YouTube live, right? So you have an option to go back to that portion where I described something. But if you have a doubt, which is like an extension of what I've told, then of course I'll cater to that. But I will not entertain the doubts of please repeat, because of course you have the option to go back in the session, right? So these are certain rules of our session, okay? And yes, the recording of this session will be available just here on YouTube. And before I begin, put a thumbs up in the video, like yes, we are ready to begin. I want your interaction throughout. Put a like on the video, share it with your friends who are preparing for SBR. Let's make it more grand and, share this important resource with everyone. Many students, almost it's been 5 years, many students since 5 years, I've got this feedback. Go and check out the previous grand revisions and its comment section. People have just passed by watching these sessions. So these are very important and very easily available resource. So please take full advantage of it. That's what I can suggest, right? Okay, so now let's begin. Let's begin with our session. I want likes on the video right now. Yes, are we ready? Yes, let us begin with it. Awesome. Let's start. So first of all, guys, I'm going to make the notes on the words. Of course, I will share the PDF with you after the class in the description box itself. Plus, there is a free WhatsApp group that we have. If you are someone who's joining in, like, for the first time in the session, like you've never been to my session before. So we have a free WhatsApp group. So let me just jot down those points here for you. So first thing is, if you want to visit or enroll somewhere in the crash course or the September batches of FR or SBR, you can visit www.pgprofs.com. That's a short thing. And then secondly, please WhatsApp at +91 9877637809. This is the number that we have for your queries. Plus, if you just put a hi there, you'll get a response, automated response, where you'll get access to free WhatsApp groups where links like this video or notes after the class are shared. So be sure that you're part of it. Then this is about the ways you can communicate to me. You can also communicate to me via this number, just on WhatsApp, not calling. Okay, so this is what we have. Then let us discuss. See, the notes will be available after the class in description box, that's for sure, right? So that's about the rules of the session. Now let's discuss about the format of our exam. That's also equally important. So let's talk about SBR format. I believe FR format is quite known to everyone. Let's talk about SBR format. So in SBR, we have question number 1, which is coming out for 30 marks, right? Which is including group accounts. So you all know group accounts basically means consolidation, where 2 or more companies, they make their or prepare their accounts together, right? So consolidated P&L, consolidated balance sheet, consolidated cash flow for SBR, that's what we have. Then we have question number 2, which is going to be for 20 marks. Now that 20 marks are given for standard knowledge, like there would be a standard tested, like for example, IFRS 9, IFRS 16, right? So standards like these will be tested in addition to ethics. So ethical, requirements will also be there, where maybe you are supposed to comment upon whether the accountant was following the ethical principles or not, or what threats were he facing. So all that stuff comes in question number 2, where you even have 2 professional marks, right? That's my question number 2. Then question number 3, it comes from gray area, and it is for 25 marks. Now it can be from various areas like leases, IS 19, IFRS 2. It can be from IFRS 15. So nobody knows about from which area this question will be tested. So this is why I call it as gray area of your syllabus, right? So here we are quite helpless, like what to prepare. That's why we are supposed to basically prepare for literally every standard so that we are able to deal with such gray questions. Then question number 4, that is going to be again for 25 marks. And this usually includes again a lot of standards, so gray area. Plus there will be something from current issues slash technical articles. For example, you could be asked about advantages of integrated reporting. For example, you could be asked about what is the effect on financial statements because of climate change. So all these are part of your technical articles or current issues. You could be asked about IFRS S1 and S2. I've already made a video on that. You can watch it on my YouTube. Just Google IFRS S1 and S2. You'll find my face somewhere there. This question also has 2 professional marks, right? And in total, that means I have 4 professional marks in SBR. So that means wherever there are professional marks available, just a small note for you for your sake of presentation, wherever professional marks are available, always write in paragraph form with small headings just to improve the presentation. Elsewhere, that means in other places, bullet points can be used because nobody is judging your presentation in rest of the requirements where there are no professional marks available. Now that is about our format of SBR, right? Now guys, let's come to the topics of FR plus SBR both. First is conceptual framework. Now let us understand what is this conceptual framework. It does not seem to be a standard, it does not seem to be a rule, but still it's an important part of our syllabus. So why is this conceptual framework even important? See, conceptual framework is a set. It is a set of theoretical principles on the basis of which IFRSs are made. IFRS slash IS are developed. So that's what basically conceptual framework is. So it's like Bible of, or instead of Bible, you can say holy book. It's like a holy book for accountants. So just like, whenever we are stuck in our life in any situation, we refer to holy book or holy teachings that, what I can do here, what would my God believe that I should have done in this situation. Similarly, when an accountant is stuck in any situation, he refers to conceptual framework, that how should I treat this particular transaction, because I do not have the sense of doing it on my own. That's why I need a help on it, right? So that's what conceptual framework is. So conceptual framework tells you about qualities of financial statements. It tells you about the elements of financial statements. It also tells you about how are you supposed to derecognize something. That means what is the derecognition criteria. That's what is given to you, the derecognition criteria. Then you're also told about recognition criteria. Also, like how are you supposed to present something, that is also given. So this is what CF talks about. So what are the qualities of financial statements? We have primary qualities and then we have secondary qualities. Can you name the primary qualities in the chat box? What are the primary qualities of financial statements, that is balance sheet, P&L, cash flow, statement of changes in equity, what are the primary qualities? Yes, what are the qualities? Come on in the chat box, everyone. What are the primary qualities? Very good. Number one is relevance. Number two is faithful representation. So what is relevance? That financial statements must be relevant. That means everything that is material is included in my financial statements. That's what I call as relevance. Nothing is omitted. Nothing material is omitted. Nothing is obscured, omitted or obscured. Right? That's what I mean by relevant. Now, what is faithful representation? Faithful representation means complete, neutral, and free from error. All the financial statements in their true sense, okay, they should be complete, neutral, and free from error. They should not have any mistake within them. That's what faithful representation is. Plus, faithful representation also includes the fact that financial statements are prepared on the basis of substance over form. Now, what do I mean by substance over form? Substance over form can be tested in an application way for you, specifically in SBR. For example, you can get a question. If I was an examiner, I could have made a question out of it. Describe, describe how various IFRSs show the real application of the principle of substance over form. So guys, what will you answer here? For that, you must know what is substance over form. So many bouncer questions, that's how they are made. There is a principle, underlying principle around which the examiner, just pickles around with it and makes a question out of it. So substance over form basically means that I consider the economic reality. So you can say accountants, as per the conceptual framework, must consider the economic reality of a transaction over its legal form. So legally it might be a sale or legally it might be a purchase, but you are supposed to look at its economic reality. Like, have you obtained the control? Has the control been transferred? So it's like we see the reality as per the economic value, as per the accounts value, as compared to what is legal. So what are the examples of it? First example is sale and lease back. So actually, guys, in sale and lease back, we are saying we are selling a product or a good or an asset. Okay, we are selling that asset and we're taking it back on rent. So legally, it is a sale. Actually, yes, you have gone and made that agreement of sell, and you have actually transferred the ownership of that particular property to the counterparty and then taken it back on rent with a rental agreement. So you have done all of that stuff. It's a real sale as per the legal format. If you were taken to court of law, this was a sale. But still, we say that refer to IFRS 15 to see whether it's a sale or not, to see whether the control has passed or not. So basically we are saying that in sale and lease back, legally it is a sale, but we still refer to IFRS 15. So we are looking at what? We are looking at its economic reality as compared to its legal form. Another example of it, sale and repurchase. So when I sale and repurchase, it's basically a sale only. But still, there's an option in IFRS 15 that do you want to consider it a sale or not? It depends upon whether it's a forward call or put option. So yes, this is also an example of legal substance is taken secondary and economic reality is taken primary. Another example, deferred tax. What is, why so? See, deferred tax, legally you're paying tax on certain amount only. What tax you're paying to income tax authorities, that's as per the norms, as per the tax laws only. But still, we go ahead and talk about that, because in future we will save tax. This is deferred tax. So we are looking at the economic reality and we are overstating or understating our income tax accordingly. So this is what can be asked as a question to you. So make sure that you know the meaning of economic substance over legal form, right? Okay. Now, what are the secondary qualities of financial statements? So, what are less important factors as a quality? Number one, the financial statements must be comparable, right? So, they must be comparable to previous years and to competitors. Okay. So, it should be comparable to previous year's financial statement, to competitors' financial statement, and many more stuff like industry average or various other industry. So it should be comparable. Then it should be timely. That means I should present my financial statements in the right time span. Now, I will not really acknowledge the financial statements of 2015, right? I'm starting in 2025. I might acknowledge the financial statements of this year, last year, but not, before that. So it should be timely so that people can make right decisions on the right time. Then they should be understandable. Now that means it should be in the language of a layman as well. You should not be using too many technical words. Then lastly, it should be verifiable. How can you verify something? There should be some supporting or source documents so that you're able to trace and vouch. What is trace? I pick up a bill and I trace whether it was correctly recorded or not throughout the process of accounting. Whether that bill was correctly recorded in the journal, then it was correctly recorded in the ledger, and then in the trial balance, and then in the P&L, and then in the balance sheet, and then in the notes of accounts. That's tracing. What is vouching? I pick up something from the balance sheet, I trace it back or vouch it back to P&L, vouch it back to trial balance, vouch it back to the ledger, back to the journal, and then back to the source document. So stuff must be verifiable in terms of tracing or vouching, right? That's what secondary qualities are. So this is what is stated by conceptual framework. Now, how can the examiner test these qualities from you? For FR, they can ask you direct questions. For SBR, guys, there can be a twisted question that how a certain standard is aligning with the conceptual framework. For example, how IS 19 aligns with conceptual framework. So there you can say that IS 19 says take the remeasurement component via OCR. So that remeasurement component is not so material to us because it is going to happen every year end. So it's less relevant. That's why we've put it into less important statement, that is OCR. So basically, I'm just giving you a very minute example of how qualities can be, aligned with various standards. So every standard is made with keeping in mind these qualities. Okay. So if you want to relate CF with any standard, you will first refer to relevance and faithful representation. Okay. Then what are the elements of financial statements? Number one, we have assets in there. What are assets? Assets are economic resources, okay, which will, like, they will lead to an economic resource inflow. So assets are inflow of economic resources, and we don't talk about probability concept here, which is because of a past event. So something that you did in the past, which will lead to future inflow of economic resources, that's what you can control. So that's what I mean by an asset. These are the most important parts of the definition of an asset. Inflow of economic resources, which is because of a past event, and that is something that I can control. Then I have liabilities. What do I mean by liabilities? It's an obligation. Okay, it's a present obligation that you might end up having an outflow of economic resources, which might end up giving an outflow of economic resources. And again, that is because of a past event. Again, we don't talk about probability here. Until 2018, we were talking about probability, but in 2020 onwards, we have 2018 onwards, we have stopped talking about probability concept. Before 2018, this word was economic benefit instead of resources. That's also an amendment. Then we have the definition of expenses. So expenses is everything bad. So expenses is something which will lead to decrease in equity or decrease in asset, increase in liability, and decrease in equity. That's what I mean by an expense. On that, if you remember, one of your questions, I believe it was Margi company in SBR, there is a question which asks you directly that IFRS 2 share-based payment doesn't align with CF definition of expense. Why? Because in IFRS 2 share-based payment, what's your journal entry in equity settled share-based payment? What's our journal entry in equity settled share-based payment? Come on, tell me. It is expense debit, equity credit. So I am creating an expense when my equity is increasing. So that goes against the definition of expense because expense means decrease in equity. So this is something which is not aligning with the standard. But if there is a war between the standard and the CF, then who wins? If CF says go left and standard says go right, will you go left or will you go right? It's the standard who wins. It's the standard who wins. We will go right. Yes. So that's what we are supposed to discuss here. Then we have the definition of income as well. So everything good is an income. Everything good is an income. That means if there is a decrease, or you can say increase in asset, decrease in liability, or increase in equity. Increase in equity. So that's basically our elements of financial statements. In addition, of course, we have equity as well. So equity is nothing but your net assets, like whatever is your share capital, share premium, revaluation surplus, retained earnings, all of that equity section of the balance sheet, which are actually reflecting the residual interest in the net assets of a company. Net assets of a company. That's what our equity means. Then when do you de-recognize any element that you've recorded? See, you de-recognize any element that you've recorded whenever the control passes. When does the control pass for that particular asset, liability, income, or expense? The control passes when the risk and rewards are transferred. Risk and rewards are transferred. How do you get to know about the risk and rewards being transferred? Like you've received the payment of the property that you wanted to sell, the ownership title has been transferred, now you can't use that property. So all that stuff reflects the passing of control, right? Then if there's any retained component, so calculate the fair value of a retained component. Okay, so you're supposed to see, maybe you had 100% of the asset, like a building with 4 floors, but you just sold 3 floors of the building, so one is still with you. So you're supposed to de-recognize only the part which is being sold. For the remaining part, you're supposed to record it at fair value, right? So fair value of retained component is taken into account, And also you're supposed to calculate profit or loss on disposal of that asset. Disposal of that asset. That's what you have to make sure. Whatever you've controlled since now, and now you've been selling it, so you've lost the control. So only on that portion you calculate the profit or loss. So if you remember, IFRS 16, sale and lease back. See, I'm revising this with you. So I am expecting you to remember stuff. IFRS 16, sale and lease back, when we are talking about transfer is a sale, I'm talking about that situation. We calculate the ROU in that as PV over FV into CA. So we take present value of future lease payments divided by fair value of the asset into carrying amount of the asset. That's how we calculate the retained component. And then we calculate the profit or loss only on the sold component. So we are applying this B recognition criteria only. We are seeing how much is still with us. We have sold something, but we've also taken it back on rent. So we still have a portion of that asset with us, right? So that's what we have in the D recognition criteria. Then we have something in recognition criteria: when to recognize an element. Recognize it whenever it is relevant to be recorded, okay? And whenever there is faithful representation. That's when you should record that particular element in the financial statements. Now, you might wonder that this topic was very small when looked at it in individuality, but see how important its application is. How there are few questions which are being asked along with very basic, you know, kind of concept, like how IFRS show real application of principle of substance over form. Then there was a question of Margi, which we did. Okay, there were so many questions related to CF, where they try to relate a particular standard with the conceptual framework, right? Then we took an example of sale and leaseback for derecognition criteria. That how do you first calculate what is the retained portion, and then you calculate the profit or loss on the remaining part. Yes. So there are a lot of stuffs which are given apart from this in the conceptual framework. For example, measurement basis is given to you. That means you're supposed to how are you going to decide whether to go for historical cost model? Yes, whether to go for historical cost model or whether to go for current cost. So current cost is basically your fair value. Historical cost, your carrying amount. So how do you decide between these two models? So there are certain factors that you consider, which can be asked to you directly in the exam. You see how the particular asset or liability contributes to future cash flows. That means whether it is long term or whether it is short term. If that asset is long term, you keep it at cost. If it is short term, you keep it at current cost. So how is it contributing to cash flows? What are the characteristics of individual characteristics of that particular asset or liability? Then you know, what are the cost and benefit? Like if I actually take it into account, what is the cost of calculating its fair value versus the benefit of recording it at fair value? So there are a lot of stuff that you consider before deciding which measurement basis to choose. That's it. So this is all in all a revision of conceptual framework. Are we guys clear on conceptual framework, all of us? Any doubts still here? Yes, come on in the chat box. Be quick in your responses. That's great. Awesome, no doubts. Let's move on. Let's move on to non-current assets. Yes, non-current assets. Now, what do you mean by non-current assets? Any asset that you own for like more than 12 months and which you can control as well. That's what non-current asset means. So there are three kind of non-current assets. One is investment property, another is IS 16, property, plant and equipment, another is intangible asset. So let us actually understand the differences between all these three. Yes. So let's understand the differences between all these three. So I will just, yeah. So we have IS 16, property, plant and equipment. Then we have IS 38, intangible asset. Then we have IS 40, investment property. So there are slight differences in these standards regarding its initial, you can say, setup and its subsequent setup. First, let's talk about the definition of it. So first, let's talk about the definition. Okay. So definition of property, plant and equipment. See, what is property, plant and equipment? It is something which is a non-current asset used in the process of manufacturing, manufacturing, in the process of manufacturing, administrative purposes, or it is used for rental purposes. These are the purposes of property, plant and equipment. What are intangible assets? You can get a question in FR directly that what are the conditions to be met to identify intangible assets. Similarly, you can get it in SBR as well in application form. See, intangible assets are non-monetary assets. That means they cannot be easily convertible into cash. Okay. Secondly, they have no physical substance. That means I can't transfer them from one room to another or from one place to another. Then I have a reliable measure of intangible assets. Then they're identifiable. That means either I can sell them separately or arising out of arising out of legal or arising out of legal or contractual right. Legal or contractual right. So basically they're identifiable. Either I can sell them separately or they're arising out of legal or contractual right. That's what I mean by intangible asset. Then what do I mean by the investment property? See, investment property is very simple. Investment property is something which is idle, which you are going to use for capital appreciation, or you purchased a property just to earn rentals. So most of the times, let's suppose there is a person working in corporate, he buys a property. He does it just because he wants to make his capital appreciate. So that's a real estate investment. That's an investment property. You don't want to use it in your own business, right? So that's investment property. Now, what are the initial accounting treatment for all these three standards? First of all, for the IS 16, you keep it at cost. How do you calculate the cost? Cost is calculated as purchase price plus directly attributable cost, okay, plus what present value of future, or you can say present value of dismantling cost. So while buying the asset, you know that yes, this much money I will be end up paying in dismantling process. So present value of dismantling cost. Then you also add irrecoverable taxes to this, correct? And for your dismantling cost, you even create a corresponding provision and you unwind the interest on it because you've calculated present value. So that's the initial cost, which is same for all. So it is same here, same here. There's no difference. Then directly attributable cost, I've put a star on it. Why? So see, directly attributable costs like cost of training the staff to use an asset is not capitalized. Why? Because you can't control it. You can't control training cost or training impact. So basically, directly attributable cost is any cost which is incurred to bring the asset to its useful situation. So today I can use a washing machine because I have got it from the shop and got it installed in my kitchen or the wet area. So I actually got it installed. So I must have paid some money to buy the washing machine plus for its transportation and then its installation. So in the installation, there's also training. Sometimes people train you how to use a washing machine, but I will not capitalize that cost because I can't control. So maybe there were three people who were taught about training and how to use the washing machine, but they won't use their brain in the similar direction, or they won't actually be same. So training costs cannot be controlled. That's why they are not capitalized. Then what is the subsequent accounting treatment? That's equally important. Let's understand the subsequent accounting treatment. So for this PPE, we have cost model where we keep, so we have cost model where we keep the asset at carrying amount. So asset is kept at carrying amount. What is carrying amount? It's basically the cost of the asset minus the depreciation of the asset, okay, minus any impairment that has occurred. Then there is another model which is revaluation model. In this, you take the asset to its fair value. So asset is taken to fair value only when the difference between cost and fair value is significant. Otherwise, you won't revalue it. Now, if it is a revaluation upwards, you're supposed to do it via other comprehensive income and create a revaluation surplus. Then, if it is revaluation downwards, that means the value of that asset has decreased this year. So, first take it out from previous revaluation surplus related to that asset. If it is not netted off against that, then the remaining via, tell me which statement? Remaining via statement of profit and loss. That's what the rule says. Then if you are supposed to depreciate, depreciation on revalued asset happens at the revalued amount using the remaining life of the asset as base. So you take remaining life of asset as base, right? Then make sure that in IS 16 that there is no cherry picking allowed. That means if I am revaluing one asset, I'm supposed to revalue the whole class of assets. That's what the rule looks like in IS 16, which is again exactly same in IS 38. The only difference in IS 38 is that we do amortization. Okay. Instead of depreciation, we do amortization. And secondly, there are two types of assets. One is definite life intangible assets, which are amortized. So definite life intangible assets are amortized, and indefinite life intangible assets, we look out for its annual impairment review. So we get annual impairment review done for indefinite life useful asset. Then in intangible assets, there's also a concept of how to differentiate between research and development. So research versus development. That's also a concept in IS 16, right? Research was, sorry, IS 38. So research is expensed and development is capitalized. How do you get to know about development? For that, Pirate criteria must be met. What is Pirate? Here P stands for probable inflow of economic benefit. Then I stands for intention to complete the development. Then R stands for resources to complete the development, ability to complete, ability to sell or use the developed product, technical feasibility, that means it's technologically possible. So technical feasibility. Then you have a reliable estimate. Yes, you have a reliable estimate of that expense that you will incur on development. So this is what you see whether these criteria are met or not. And if yes, then you capitalize development. So development is capitalized and research is expensed. Rest everything is same as IS 16. Then what I have in investment property now, that's also very important for us to know. What do you know about investment property? See, subsequently, there is a cost model, so which is quite same as your IS 16 and IS 38. So that's just a copy and paste. The next model, instead of revaluation, is fair value model. So next one is fair value model. So what happens in fair value model exactly? Let's understand. Here, the asset is taken to fair value at each reporting date. So you don't wait for the difference between the fair value and carrying amount to exceed significantly. You do it at each reporting date. Now, because this is something which is an investment property, so you're not using it, it's idle. So no depreciation is charged in fair value model. No depreciation is charged, right? And asset is taken to fair value at each reporting date. The gain or loss goes via statement of profit and loss. See, now this question can be asked to you specifically in SBR, that why there are such differences between revaluation model and fair value model. So why there are differences between these two? Here the gain goes via OCI, here it goes via P&L. Why? This is something which can be a question in the exam. So what will be your answer? See, you are not parrots that whatever I've told you, you'll just write that. Just think about it yourself. P&L is a primary statement. Statement of profit and loss is a primary statement. And statement of other comprehensive income is a secondary statement. So basically anything that is important goes to P&L, which is less important goes to OCI. Now revaluation upwards, is it less important? Answer is no. But the fact is that I purchase property, plant and equipment to use it in my business, isn't it? I purchased it to use it in my business. So that was my objective. Its value increased. That is something secondary to me. My objective is that this property is my office space. The value of the office space has increased, blah, blah. That does not matter to me at all. So it's a secondary element for me. Anyway, I'm not selling this property, right? That's why its gain is going via OCI because it is less relevant to me. But something like investment property that I only purchase with a viewpoint of getting a capital appreciation on it. I did that investment just because I wanted capital appreciations. That's what my first objective was. So because that first objective has been met, because that fair value has fluctuated, so the gain or loss is going via P&L, right? So this is a type of question that you might be asked, that why in revaluation model it is via OCI and in the investment property it is via P&L, right? So these are the basic differences between the three standards. Let me know in the chat box, are you guys clear on it? Awesome. Let's go. Let's talk about another standard. Now this is IS 36, impairment. Let's make our short note on that. IS 36, impairment. Impairment of assets. See, what is impairment actually? Let's first understand what do I mean by impairment. So impairment is a bad concept or a sad concept. So it's basically reduction in value of asset, reduction in value of asset. Now for that reduction, I have to look for indicators. So there are two types of indicators: external indicators, which are basically not in control of the entity. For example, climate change. So there's a topic in your syllabus of SBR about climate change. It's an external indicator of impairment. For example, pandemic. It's an external indicator of impairment. For example, fire, something like that, loss by fire, etc. So these are all external indicators. So if any such event has happened during the year, that might indicate that yes, there was an impairment. Then there could be internal indicators as well. What are internal indicators? For example, the productivity has declined. So for example, you used to produce 100 units per minute. Now you're just producing 10 units per minute. So productivity has declined. Then maybe your key personnel has left the entity or the company. So basically, the people who were using the asset or that particular factory or that particular equipment have now actually left the company. So it's difficult that nobody would be able to use that particular equipment or machine in that way. So again, that is something which is an internal indicator of impairment. Now, based on these indicators of impairment, we see or we conduct impairment review. What is impairment review? In impairment review, you actually compare, in impairment review, you actually compare the carrying amount of the asset with the recoverable amount. And you take lower of both of these. So you compare the carrying amount with recoverable amount. Carrying amount is coming from the balance sheet, from the financial statements, which is basically your cost minus depreciation minus any previous impairments. What is recoverable amount? Recoverable amount is higher of two amounts. That is value in use and fair value less cost to sell. Now, what is value in use? Value in use is present value of future cash flows if the asset is assumed to be used. Asset is assumed to be used until the life is over. Until the life of asset is over. That's basically value in use. Then what is fair value less cost to sell? You all know fair value comes from IFRS 13, and cost to sell includes all the costs, minor costs that might be involved in selling that particular property or that plant, right? So that's basically our recoverable amount. Now, while calculating value in use, you're supposed to take few things into account. Make sure that number one, you are using a zero, negative, or reducing growth rate. So either the growth rate is reducing or it is zero, right? That's what you have to assume. Now, once the recoverable amount is there, you compare it to the carrying amount and you take lower of both. Now, if there is a if there's an impairment, then impairment loss is treated same way like you treat revaluation downwards. That means first you take it via previous any previous year's revaluation surplus. If still it exists, you will take it via statement of profit and loss. That's what impairment review looks like, right? Then let's talk about another concept in impairment, that is cash generating unit. So what is cash generating unit? It is the smallest group of identifiable assets which cannot generate independent cash flows, but if put together can generate cash flows. So if I talk about a bar, in a restaurant there's a bar. So within a bar there are bar chairs, there are refrigerators, then there is some crockery line, then there is an air conditioner. So all these things separately, they do not generate any cash, they do not generate any revenue. But when I put them all together in one single section of the restaurant, then and I call it as a bar, then yes, it can generate independent cash flows. So individually they can't, but when they are put together, they can. That's what a CGU is. Now a CGU might actually be impaired as well. So to them, goodwill is allocated. So goodwill of the entity is a corporate asset. Corporate asset is something which is omnipresent, just like God. So corporate assets are present in all the CGUs. So if there's a restaurant chain of JW Marriott and they have 10 different CGUs, that is a pool area, then there's a bar area, then there's a room area, then there's a party lounge, and then there is a banquet hall. So there can be various CGUs in that particular hotel chain. But to all the CGUs, the goodwill of JW Marriott is going to be allocated because it is corporate asset. It's omnipresent. People are going to come to those areas because of the name of that JW Marriott. So goodwill is the of the entity is a corporate asset in this case. And how are we supposed to allocate? How is impairment allocated? Just a minute. How is impairment allocated to a CGU? See, first of all, you're going to allocate it to a damaged asset. Then you're going to allocate it to goodwill. And then you're going to allocate it to rest of the assets. on pro rata basis, right? And make sure that do not impair current assets. So you're only supposed to impair the non-current assets and not current assets because they're already at lower of cost and NR. So this is what we have for our IS 36 impairment. Then guys, lastly in the segment of NCA, we have a standard IFRS 5, which is non-current asset held for sale and discontinued operation. Highly examinable in SBR, FR and AAA as well. So non-current asset held for sale and discontinued operations. So if you have any asset that you want to sell in the future, so for any asset to be sold in the future, we have to see whether it meets the following criteria or not. That is caption. So caption must be met before we classify it as held for sale. Now, what is this caption criteria? Can you tell me what is the caption criteria? Yes. What is the caption criteria? C. C stands for commitment, commitment to sell. A stands for active plan to sell. That means you've started looking for a potential buyers. P stands for probable sale. Then sale in present condition. Then within 1 year, the sale will happen and there will be no change to the plan. That's what caption means, right? If caption is met, then only an asset can be held for sale or it can be considered that yes, we want to sell it. Now, once it is considered as held for sale, what is the accounting treatment of that asset? See, number one thing is accounting treatment of non-current asset held for sale. Number one, stop depreciating that asset because now you're going to sell it, so you're not going to use it, so you'll stop depreciating it. You will take it to lower of cost and net realizable value. So basically, you're going to impair your asset because in this case, there will be no value in use because anyway, you're going to sell it. Then you will classify this particular asset as current asset. Classify the asset as current asset because now you're going to sell it within 1 year, that is 12 months. So yes, it can be classified as a current asset, right? Then if by chance the sale does not happen within 1 year, so what will we do? If the sale does not happen within 1 year, what will we do? We will look at the reasons of delay. Were they in control of the entity? In control of entity? That's what you have to see. If the answer to it is yes, they were in control of the entity, then stop applying IFRS 5 retrospectively. That means go back and change your accounting treatments. There was no need to apply IFRS 5 if you were not able to sell it within 1 year. But if the things were not in your control, if these were unavoidable issues, if they were not in your control, then from today onwards, see, if asset is still being able to be sold, being able to be sold in 1 year. So are we selling it from now till the next 12 months? If yes, keep applying. IFRS 5? If no, then change it prospectively. Reclassify your asset, the asset from IFRS 5 prospectively. That means today and tomorrow, current and future timeline. You're not supposed to go back in the timeline and change the stuff, right? So if the things were in your control and you did not sell the asset within 1 year, then you're punished harder. That means you're supposed to do a retrospective adjustment. Otherwise, a prospective adjustment is required. So that's what we have in IFRS 5, non-current assets held for sale. Then we also have discontinued operation. What is discontinued operation? See, if you're going to close or sell a separate major line of business, which is a separate major line of business, either because of its geography, or it is a separate major line of business because of its nature, whatever is the situation, and you're wanting to sell that, then it's a discontinued operation, right? It can also be a subsidiary which was purchased with a view of reselling. So any subsidiary that you knew from the date of its purchase that I'm going to resell it, that is also a discontinued operation. What do you do for discontinued operation? In addition to above accounting treatment, that is no depreciation, etc. In addition to above accounting treatment, what is extra that we do for discontinued operation? Number one, we show profit after tax as a separate line item in statement of profit and loss. So we show profit after tax from discontinued operations as a separate line item. Then we also, classify it as current assets, and all that stuff is still same. So this is extra that we do in discontinued operation. That's it. This is what we have in IFRS 5. Do you understand this? Are we clear on IFRS 5 as well? So basically, we've revised conceptual framework, which we also revised some application questions. Then we revised differences and the in-depth analysis of IS 16, IS 38, IS 40. Then we revised the IS 36, and then we revised the IFRS 5. Of course, there are more parts to these standards, but what is the gist of it is what we have revised. Correct? Okay, so those who are still having any doubt, please go back in this live recording. Like it's a YouTube live, so you can move back and forth and just go through that portion again. We'll take a small break of next 5 minutes, okay? And then we will continue with the other standards like IFRS 15, 16, and 9. So let's take a small break of 5 to 7 minutes. Yes. So I'm muting myself. Don't ask me why ma'am is not speaking. I can't hear. So come back after the break, okay? We will complete this today itself. Don't leave it for the recording because then things pile up and then you end up doing nothing, right? So watch it live. It's better for you. So let's take a small break now. Yes, guys. Am I audible again? Shall we resume with the session? Please let me know in the chat box if I'm audible to you. That's great. So let us resume with yet another very important standard again for both FR and SBR, that is IFRS 15. So we are going to start with IFRS 15, revenue from contracts with customers. Just a small tip for SBR students and even AAA. If you're not aware about the name or the number of the standard, please avoid mentioning it. I have recently checked mocks of few students and I saw that, they have very confidently written wrong numbers of the standards and names. Like instead of IS 40, it's written IFRS 40, right? So, yes, this is something which is not required. So kindly omit it. If you don't know the number, the exact way you're supposed to present it, just state as per the relevant standard. Don't write the exact number. Yes, so Maya, testing cost is included. Okay, now let's go on and talk about revenue from contracts with customer. First of all, here we are talking about revenue from normal course of business. So I'm not talking about that I sold, I've just sold something like just an asset. So I cannot say, yes, I cannot say that that is revenue for me. So revenue is basically which I sell in normal course of business. That's basically what I do the work for. So that's basically, for example, if you are selling products of, let's suppose you are selling electrical equipments. So that's your normal course of business, right? So whatever you generate as money out of selling those kind of products, that is revenue. Then now they've given you that there are 5-step approaches to record this revenue. So what are the 5 steps? What are the steps to record revenue? Yes, steps to record revenue. So number one is identification of contract. So first of all, I'm supposed to identify that what all contract, whether there is a contract at all or not. So, for example, if there is an existence of rights and obligations or not, right? If there is a two-party agreement or not, so that's how you identify a contract. So there should be a two-party agreement. That means both the parties or more than one party should be there. So they should have recognized their rights and obligations. So each party must have recognized their rights and obligations. This particular contract should be for commercial substance. That means we are not doing it out of charity. So there should be a commercial substance to it. You should get money out of it, profit out of it, right? So that's something which is important. And then there should be a probability that you are going to probability to receive funds. So I'm going to receive the funds from the customer, and it's quite probable that this person is going to pay. So there is no bad debt in this case. So this is basically step number one. Then after identifying the contract, I am supposed to see that what are the separate performance obligations within the contract. Within the contract. So here I'm supposed to see what are the distinct performance obligations. So how can I come to know about distinct performance obligations? These are basically like from the point of view of both the buyer and seller, right? From the point of view of both the buyer and seller, whether basically buyer is also wanting to buy those services separately, okay, and even the seller is offering those services separately. So they should be distinct, right? So if they're distinct, they're treated as separate performance obligations. Basically, delivery of one good or service is not dependent on the delivery of other. So if you remember, there was a proper question on this. I think that was Z Tech company question, right? That was basically Z Tech company, which was done where we discussed about various softwares, and then we finally said that yes, this is separate performance obligation and this is not separate performance obligation. So that's basically what we have here in second step of revenue recognition. Then we have a third step of revenue recognition, that is determining the transaction price. So what do you have in determination of transaction price? Let us understand. So basically, transaction price is something that is coming out of various components. So there can be a variable consideration. So you record the variable consideration as per the expected value. You can calculate the expected value, or you see that what is the most likely amount that we will end up receiving. That's what your transaction price is, right? Second, it is also financing component. So what do you mean by financing component? If you're supposed to receive payment, let's suppose after 1 year, so you will record present value of that payment as your revenue today, and you will also unwind the interest on that. So you have to take into account the financing component. Then there is also a possibility of cash payable to customer. So how can you pay cash to customer? Either that customer is also your supplier. So that means I have also taken some goods and services from that customer. So let's suppose you have a shop and I am a tutor. So maybe I teach you ACCA, but you also have a shop. So I do buy grocery from your shop. So we both have a business relationship, right? I am your customer as well as you are also my customer. So it's like a dual street. So here maybe you are paying the fees of SBR and I am paying you the fees of the bread that I buy from your store. So there can be a cash payable to the customer as well. Then there is non-cash consideration. So non-cash consideration, see, I have to take, in this case, it's basically I am doing barter system. So I will give you SBR crash course, but in return, let's suppose I want your editing services. Okay, so I want you to edit the lectures. So this is a non-cash consideration. So when I'll be recording my revenue, I will see whether, you know, do I have the fair value of the services that I've received? So first preference is given to fair value of services received. That's how you record the revenue. If that is not available, if unavailable, then you take revenue as, then the revenue is recorded as fair value of services granted, right? That's what the rule of non-cash consideration is. Then lastly, what we have is like this is fourth, allocation of allocation of transaction price to separate performance obligations. So what you actually do is you allocate the transaction price on the basis of pro rata. So you do it on pro rata basis. I'm not supposed to tell you here how to do it. I have told you multiple times with the help of an example, the numerical, that if there was a computer being provided and after sale services being provided, how are you supposed to actually prorate the transaction price between the two performance obligations? Then the fifth one and the most important one is revenue recognition. Now, should you recognize the revenue at a point in time or over the period of time? That's the question. So see, you record the revenue at a point in time, at a point in time, whenever it is not over the period of time. So you record the revenue at a point in time whenever it is not OTP. So when is revenue recorded over the period of time? That's the question. So question is, when is revenue recorded over the period of time? So when is the revenue recorded over the period of time? It's basically recorded when any of the following conditions are being met. Condition number one, customer simultaneously consumes, so simultaneously receives and consumes the benefit. For example, you guys are sitting here and consuming this benefit. I can't take it back from you. So you're getting the training. Second, the entity is enhancing slash creating an asset controlled by the customer, which actually gives you an enforceable right to payment. Because of course this particular good is or this particular asset, I can't like construct it, and whenever the customer says go out, I don't want you as a contractor, I'll have to leave, right? I can't be like Bob the builder and pick up that building and leave. So actually this is like an asset owned by the customer. If I'm constructing that, I have an enforceable right to payment, and therefore the revenue is recorded over the period of time. Third is when an entity is enhancing or creating an asset controlled by the entity. That means this time you control it, but which is of no use, which is of no use to the entity. Basically, you have done customized or you've done some customization. That's why you can't use it, right? So even though the asset belongs to you, but you're creating it in such a way that you can't use it for your other purposes now, or you can't sell it to anyone else now. Maybe you have made it very much customized. So in that case, also the revenue is recorded over the period of time. Now, these are the 5 steps of revenue recognition. Finally, in this particular topic, we have a very tricky part, that is sale and repurchase. So let's discuss sale and repurchase. See, legally you're selling something, but you have an option to repurchase. So is that a sale? That's what the question is. So there are 3 types of arrangement. One is forward. What do you mean by forward? The seller has given or seller has an obligation to repurchase the goods back at a fixed time in the future, at a fixed time and price in future. If that is the case, guys, then it is a forward contract. And if it is a forward contract, it is not a sale. And if it is not a sale, then what it is? If the original selling price of that particular good is, or you can say if the repurchase price is greater than the original selling price, that means the price at which we are going to buy it back is greater than the original selling price, then we treat it as a loan. If the original or if the repurchase price is lower than the original selling price, then we treat it as a lease, right? That's what a forward looks like. Then what we have, is call. There is a call option. In this call option, what exactly we do is that there is the seller has an option to call his goods back, If this is the situation, the accounting treatment is same. It is not a sale. And then if the repurchase price is greater, That's what happens. So it's same, right? Yes, it is not a sale. And if repurchase price is greater, then it's a loan. If it is lower, then it is a lease. Lastly, the third point is put option. Put option. So put option is basically option with the buyer to return the goods. Now, if the put option comes with obligation, that means the seller has an obligation to take it back. Yes. So basically, with obligation, seller has an obligation to take it back. Then again, the situation is same. It is not a sale and copy paste when it is a loan and when it is actually a lease, right? So that's that same. But if the put option comes without obligation, if it comes without obligation, what do you mean by it? Without obligation, that basically means that now seller has no obligation to take it back. So seller does not have any obligation to take it back. Then only in that case, it is a sale. So in all these situations of sale and repurchase, it is a sale only when it is a put option without obligation. Otherwise, it is always not a sale. So on this, you had a very, in SPR again, in FR, this can be tested as a MCQ maximum. But in SBR, you had this question, Jacinta company, isn't it? Where we did the question on when there was a sale to Sear, equipment was being sold to Sear. So in that case study of Jacinta company, I think it was part of your Super 20 as well. There was a put option with obligation, but still we went with substance over form and we said that even though there is an obligation, but still the rules or that agreement is that the selling price is going to be way higher than the repurchase price. So due to such reasons, it was less probable that, there will be a repurchase. So that's why we said it is a sale. So that was a very crucial topic. Like just go back and revise Jacinta company, where an equipment was being sold to Sear company, right? Okay. I hope we are clear on this. This is option with the buyer. So just have a quick revision of it. Maybe you can go back and rewind the video and revise it or take a screenshot of it. And of course, you'll get the notes, but still for the moment, you can take a screenshot of this. It's a very, very important concept. Okay. Now let's move on to IFRS 16, that is leases, which is again important from both the perspective of FR and SBR. So IFRS 16, we are going to talk about leases here. So I'm going to talk more about sale and lease back. So I will just sum up leases in a very short and a crisp manner. So when do you have a lease agreement? It's like when you rent out something, right? So when you say from the perspective of a lessee, who's lessee? The person who takes the asset on rent, right? And who's the lessor? Lessor is the person who gives the asset on rent. So now you know who's the lessee and who's the lessor. Now, being the lessee, you are going to have a right of use asset being recognized and a lease liability being recognized. Now, the question is, in this right of use asset, yes, in this right of use asset, how are we supposed to uh, record an ROU? So ROU is recorded only when you have control over the leased asset. That means you will direct its use. Direct its use. Now, there's a possibility that in the lease agreement, there's a restriction on you that you can't use it after 7 p.m. So that's a normal restriction, but you will direct its use. You will decide for what purpose you're going to use the leased asset. So that's when an ROU will arise. What is lease liability? The present value of future lease payments. So what happens in initial treatment of lease? In the initial treatment, you record ROU. ROU is recorded as present value of lease payments. That means lease liability. Yes. In that you add any payment made on or before the commencement of lease. For example, any security deposit that you have paid, that is also going to be treated as part of ROU, right? And subsequently, an ROU is depreciated, that's for sure. But let's talk about what and how do you record lease liability. So lease liability is recorded as present value of lease payments. So what kind of discounting factor do we use? The discounting factor is a rate implicit in lease. So the interest rate given in the lease contract or incremental borrowing rate, whichever is available. Incremental borrowing rate. Now, once you have done this initial treatment, what is the subsequent treatment? Subsequently, the ROU is depreciated on shorter of lease term or life of asset. If it is a financial lease, that means you are going to keep this lease for with you for like the whole life of the asset. Then, of course, you will use the life of asset as depreciation rate. Then, lease liability. You're supposed to calculate unwinding of interest. So, on lease liability, unwinding of interest happens, right? That's what we do subsequently. This is our lease treatment. In the books of the lesser now, this was in the books of the lessee. So now the lesser. Lesser is going to divide the leases between operating lease, which are general leases. Like you're going to treat it as your income accrued. You'll record your rent receivable as your income accrued. And then there are finance leases, where you actually de-recognize the asset, right? You de-recognize the asset and you record a receivable. Like you record a lease liability in case of lessee. So here you record a lease receivable in case of lessor, right? And you de-recognize your asset. So lease receivable debit and asset credit. That's what your journal entry looks like. There are various indicators which suggest whether this is a finance lease or not. So for example, the lease term is very long or the life of the asset is quite same as lease term. Fair value of the asset is quite same as the ROU or the lease liability. So all these indicators suggest that this is a finance lease. Now comes the most important concept, sale and lease back. Let us discuss that. Sale and lease back. We are supposed to discuss it from the perspective of both the lessee and the lessor. So you are selling your asset and renting it back, but still you're referring to IFRS 15 to see whether it is a sale or not, whether the control has passed or not. So that is substance over form. So how are you supposed to do this? Let's understand. Sale and lease back. Okay. So, yes, what happens when transfer is a sale in the books of lessee, and what happens if transfer is not a sale in books of lessee, and what happens for both the situations in the books of lessor. So lessee is also basically the person who has sold his asset and took it back on rent. So seller is lessee and the buyer is the lessor. So what happens? Let's discuss when transfer is a sale. When transfer is a sale. See, the seller is going to derecognize the asset. So derecognize asset, record, you are derecognizing the asset, record maybe this is going to bring money to you, so you're going to record bank debit or receivable will be recorded. Then you're going to record a right of use asset, because this is basically you've retained some right as well. How will you calculate this ROU? It will be present value of lease payment divided by fair value of the asset into carrying amount of the asset. So PV over FV into CA, you'll record the ROU. Then you'll also record a lease liability, which is like present value of lease payments, correct? And then this is going to give you as a balancing figure a profit or loss on disposal. Here you are also in this situation, you are meeting the derecognition criteria of conceptual framework. What will the lessee do when transfer is not a sale? See, he will not derecognize the asset, first of all, not derecognize asset. Then, because the money is actually coming in, legally it is a sale. So record a financial liability, because you've received money from unknown sources. So you will record a financial liability at present value. Um, this will be treated as a loan. So whatever rent that you will pay, rent paid will be treated as interest on loan, right? Now, what will the lessor or the buyer do in both the circumstances? When transfer is a sale, the buyer is going to record the asset, because for him it is a sale. So asset is coming into the family of the lessor, and then he's going to treat it as a normal, like, there will be a liability or a payable, or bank will be credited, right? And then we are going to do a normal lesser accounting based upon whether it is an operational lease or finance lease, right? What will the lessor do in case when transfer is not a sale? He will not record the asset, not record asset. Then he will record it as what? Money has gone out for no reason. So it's like a financial asset. It's like a loan given, loan granted. Whatever rent is received, legally it is rent. So whatever rent is received, treat it as interest on loan received. That's it. This is what you will do in sale and lease back. Now, there are two situations. When transfer is a sale, within that, there are two situations. Transfer is above fair value. In that case, the extra amount is treated as financial liability. So you've received extra, then it's fair value. So that extra amount is financial liability. And if transfer is below fair value, transfer is below fair value, then you treat this as prepayment. So the first, when transfer is above fair value, I hope you guys remember a very important question from your SBR exam kit, uh, which was actually Lyra Company. Yes. And then there was also a TYU, Mosaic. So we did this question in a Super 20 as well. So we all know that this financial liability is part of lease liability. So please go through these questions where we talk about sale and lease back when transfer is above fair value. Right? Are we guys clear on this? All of us? IFRS 15 and IFRS 16. Are you all clear on it? May I get a quick confirmation in the chat box so that I can move on to IFRS 9, your favorite standard of all times? Okay. So there's a topic of subleases in your syllabus. So if all the FR students can just ignore me for a moment. So let me discuss this with SBR students. What we have in subleases basically, right? So let's discuss subleases. So under this, we have a section of only relevant to SPR, subleases, where basically what happens, let me just give you a small background of it. So take an example of a classroom, okay? So let's suppose you all know me, TG, right? Let's suppose I have a classroom in my local area, which is like my studio room from where I take classes. So it's like a classroom that I have, which has a green screen and it has all the kind of, you know, classroom is like having all that equipment that I need for teaching online. Now, my classes are just from 8 p.m. onwards, Indian time, right? Now, let's suppose there is a other tutor and I have taken it, this classroom, I've taken it on rent. So, of course, I'm not going to buy it because, of course, this is not what I would love to do all the time. So, I have taken it on rent. Okay. Now, please listen to me carefully. I've taken this classroom on rent and I'm using it after 8 p.m. So rest of the day it is lying idle. So I'm not using it, right? So I'm paying that rent uselessly. So what I do is I find some other tutor, maybe he or she is teaching uh, subjects of basic accounting to school going students. And those subjects are to be taught in the afternoon and evening hours. Okay. So this particular faculty needs that classroom in the afternoon and evening hours between 2 to 5 p.m. So my classes are after 8 p.m. I can easily, share this room with this person for from 2 to 5 p.m. So they can take their own classes and I can take my classes at 8 p.m. That's possible, right? So I am myself a lessee on this classroom for this classroom, but I might end up subleasing this classroom to this person. So I am myself a lessee, but I might end up becoming a lessor, and this person might become the sublessee. Okay, this person might become sublessee. So there are a few terms for you to understand here. First term is, I'm going to write it for you so that you remember it. Let's understand these terms. Number one, there is a head lessor. Head lessor. The original lessor. The original OG lessor. The person who rented the classroom to TG. So in my example, this is going to be the person who rented the apartment to TG. That's the head lessor. Then we have the sublessor. Who is the sublessor? TG is the sublessor because I have leased it out to that other faculty. So I am the sublessor. Then I am also the head lessee. Who's the head lessee? It's me, TG only, because I took it on rent from the head lessor. So I am the head lessee. Then there is someone known as sublessee. So who is the sublessee basically? Sublessee is the faculty who is going to teach from 2 to 5 p.m. Right? So this person is the sublessee. So you do understand who's the head lessor, who's the sublessor, who's the head lessee, and who's the sublessee. Now the accounting treatment is what we are supposed to understand. What is the accounting treatment? How am I going to account for it? See, for sublessee, it is simple. He will treat this as a lessee. That means he will record his ROU. He's going to calculate his own ROU, right of use asset, on the basis of what he's going to use from 2 to 5 p.m. and he will record his lease liability. Head lessor will record his simple based on whether it's an operational lease or whether it's a finance lease. He will do his normal accounting as per IFRS 16. Now the question is, how will TG account for it? Because I am playing a dual role here, a double role. I am the sublessor also and the head lessee also. Okay. So they also call it as intermediate lessor. So the terms are quite same or interchangeable. So I'm the sublessor also and I'm the head lessee as well. So as a head lessee, guys, I will actually record ROU and lease liability. And as a sublessor, what I'm going to record? What does the sublessor do? That part of my classroom that I'm renting out, for that, I will record on the basis whether it's an operating lease or finance lease. If it is an operating lease, what I'm going to record? Can you tell me? What do we record if it's an operating lease? Come on. If it is an operating lease, I will record my, yes, I will record my rental income as and when accrued. As and when accrued. But when it is a finance lease, what will I do? I need to derecognize the asset, but the irony is I do not have this asset, right? This is not my asset. So what do I derecognize? I should de-recognize my ROU. Very good. So related to that asset, I already have an ROU and lease liability being recorded, right? But I do not own this asset, right? So I cannot de-recognize the asset because I have not recorded it at the first place. So since it is a finance lease, I will de-recognize the ROU. Now I don't have the right of use asset, so I'll de-recognize it. Will I de-recognize the lease liability? No, because I'm still liable to make payments to the head lessor. I will just de-recognize the ROU and record a lease receivable. So I will still keep on paying my lease liability. So lease liability will still be there in my balance sheet. I will just de-recognize the ROU and I'll record a corresponding lease receivable because it's a finance lease. So I will receive payment from the lessor, from the lessee, right? Very simple accounting treatment. For TG, what it is, because I'm a head lessee, I will record ROU and lease liability. Okay, makes sense because I'm the lessee. ROU and lease liability is recorded. Sublessor, because I'm a sublessor and it's an operating lease, whenever my rental income will be accrued, I'll record it. Finance lease, if it is a finance lease, that means I've given it on sublease, which is a finance lease. So I'll de-recognize my ROU and I'll keep on recording my lease liability because I still owe the money to the head lessor. And I'll record a corresponding lease receivable. Are we guys clear on this? Very easy concept. Yes. Are you clear on it? Please let me know in the chat box. This is just for the sublessor and the person who's the head lessee. So that person is same. So there's a, concept that how should that person record it. Very calculated, technical, easy portion. There's literally any question on this concept. Okay, just know that how to record subleases. That's it. Okay. Now, guys, let us begin with IFRS 9. Let's first take a short break of 5 minutes and then we will resume with IFRS 9 financial instruments. Okay. So let's take a short break of 5 minutes and resume with IFRS 9. Yes, guys, let's resume with the session. Let me know in the chat box if I am audible to you. Let's now talk about IFRS 9 financial instruments. Okay, so let's talk about IFRS 9 financial instruments. So, how many of you are really excited about this standard? And how many of you are confident about this standard? Come on, let me know and be honest in the chat box. Is this your favorite standard? Like for FR, it's very simple. So, this question is not for FR. This is for SBR students. What do you feel? Is this your favorite standard out there? Well, let me know. So, in IFRS 9, we basically talk about financial assets and financial liabilities, right? So, financial assets and financial liabilities. What do I mean by financial assets? Now, this is something that can be tested in terms of general direct question or application question for SPR, right? So, this can be a direct question, in fact, that tell us these type of shares or debt instruments are what kind of assets to you. So financial asset is, for example, cash, or financial asset is a contractual right to receive cash or another financial asset. So it's a contractual right. So pay attention to the word contractual right. So it's not a legal right. It's not an implied right or assumed right. It is a contractual right. It's given to us in a contract that we deserve this much money. It's a contractual right. Then, then we have, then we have financial liability. Financial liability. It is basically contractual obligation to deliver cash or another financial asset. So if you're supposed to pay money to someone, it's your financial liability, right? So that's a contractual obligation again. Now, if you're settling a liability in terms of your own shares, and the number of shares that you're going to pay are variable, then also it is a financial liability. So if you are going to settle your financial liability in terms of your own equity instruments, and the number of those equity instruments are variable, that means you don't know how many shares you will end up issuing. So that is also a financial liability. Then next is, what do you mean by equity? Equity is basically residual interest in net assets of an entity, in the net assets of an entity, right? And if you're going to settle like your financial liability in terms of your own shares, your own shares, right? And the number of shares are fixed, then it is equity. So you can get a question on it in, like, for example, I think Bismuth company question was there in SBR, where we talked about whether it's financial liability or equity. So it's a financial liability versus equity question, which can be encountered in the paper. Now comes the accounting treatment. What is the accounting treatment for? Let's first talk about all the financial instruments. So for all financial instruments, they are initially recorded all financial instruments are initially recorded at fair value and transaction cost is capitalized unless the subsequent measurement or subsequent method of measurement is fair value through profit and loss. What is this fair value through profit and loss? It's a subsequent measurement method. Let's talk about types of financial assets. Let's talk about debt financial assets first. So initially they're recorded at fair value. Subsequently, we have various methods under which we can record it. One is amortized cost, which is like a by default method kind of. And second is fair value through OCI. Third is fair value through P&L. Now, how do we decide between the three? We have two tests. So number one is the contractual cash flow test. Number one is contractual cash flow test, which means that all the repayment will be received only in terms of cash. So basically, you're going to get, financial asset debt is like you've given loan to someone. So you're going to get repayment of that loan in the terms of cash only. You're not going to get it in terms of any other kind. So for example, in convertible debentures, in convertible debt, there is an option to convert debt to shares, which does not align with CCF test, and hence fair value through profit and loss treatment is applied. So fair value through P&L treatment will be used out of these three options if CCF is not met. If CCF is not met. Now, if CCF is met, then we move on to the second test, which is business model test. So basically, what is your intention? That's what we talk about here. Is your intention to keep your asset for long term? If yes, keep it under amortized cost. So let me talk it about here. So is your intention long term plus CCF is met, then amortized cost. If your intention is, I don't know, I might keep it, I might sell it based upon the situation, and CCF is met, then I'll use fair value through OCI. I will use fair value through P&L if CCF is not met, or my intention is to keep it for short term, that asset for short term, plus CCF is met. So these are the scenarios where which method I'm going to choose. Now, if you look at it very, in depth, can you tell me which part of CF is aligning here with this part of IFRS 9? We discussed conceptual framework. So which part of conceptual framework is actually applicable here? Let's see who guesses it right. Which part of conceptual framework is applicable here? Very good. So this is basically measurement basis. So this aligns with conceptual framework basis to decide measurement basis, where we discuss about the how an asset contributes to future cash flows. So we used to talk about now that if it is long term, keep it at cost. So see, if it is long term, we are keeping it at amortized cost. If it is short term, we're keeping it as fair value through P&L. If it is in the middle, like hanging in mid, we're keeping it via OCR. So see, that's how beautifully IFRS 9 is aligning with conceptual framework, right? Then what we have is, we have equity instruments. So equity financial assets. For them, we basically just have two methods. One is fair value through P&L, which is the by default method. And second, we have fair value through OCI. And we choose fair value through OCI only when the below two conditions are met. Number one, must not be held for trading. So you are not treating that particular equity instrument for trading. That's the first thing. So must not be held for trading. Second, yes, made an irrevocable choice upon designation. So when actually that asset was purchased on that day, when you actually concluded that this is a financial asset equity instrument, that date you made a choice that you will keep it under fair value through OCI. So if these two conditions are met, then only you are supposed to keep it under fair value through OCI, right? Then based on these two financial assets, that is debt and equity, we have a concept of loss allowance as well, which is just applicable to SBR students, not for FR. So there are two types of loss allowances here. One is 12-month expected loss allowance, which we create if the credit risk has not increased significantly since inception. So the day you recorded it till now, what is the increase in credit risk? Has it increased significantly or not? So we create 12-month expected loss allowance if it has not increased significantly. Then we create a lifetime expected loss allowance if the credit risk has increased significantly. Then for receivables, we always create lifetime expected loss allowance, because at the end of the day their life is just 2 months, 3 months, right? So there's no point of putting 12 months figures in front of it. So we create lifetime expected loss allowance for receivables. Now we must know that while calculating the loss allowance should be probability weighted. It should be taken to present value, right? And you must know that this loss allowance is just created on debt instruments kept under amortized cost and fair value through OCI, right? They are taken to present value, they're probability weighted. And how do you calculate the loss? How do you calculate the credit loss? So credit loss is basically the difference between the contractual amounts to be received as per the contract, how much you are supposed to receive versus expected amount to be received. And how do you create this loss allowance? You create this loss allowance as P&L debit, loss allowance, credit, correct? And if there is any debt instrument which was kept under fair value through OCI, in that case, the rule says, IFRS 9 states that an asset, that a debt financial asset cannot be taken below its fair value. So I can't take a situation where there is a bond worth $100 fair value, and loss allowance on it is $30. So I can't say that that $30 is an extra loss. I will say it is within that 100. So I will divide the fair value movement between loss allowance and rest of the movement. So the loss allowance part will go via P&L, and the rest will go via other comprehensive income, because this is fair value movement via other comprehensive income. This is what I have for loss allowances, just a gist of it, right? Because it's a very complex concept that we have covered in detail. So we're just covering the gist of it. Now, guys, we also have a concept of credit impairment. What is credit impairment? It's like a bad debt that the counterparty has made it very clear that they're not going to repay to us. In loss allowance, we were just doubting them that they won't repay. So we are comparing the contractual amount with the expected amount. But here they've made it very clear and communicated it to us that they won't repay. So this is credit impairment. How do you record this? Your entry is statement of profit and loss, debit, because it's a loss to you, and your receivable or your financial asset, credit, right? That's your journal entry. And to calculate your interest income on such a debt instrument, you will use CIAR, which is credit impairment adjusted rate. Now, something which is credit impaired, that's basically the real loss, the bad debt. But on an instrument on which a bad debt has happened, there's a possibility that there could be future losses. So there can be a future loss allowance. So how am I supposed to calculate that future loss, or how am I supposed to record that future loss allowance? That's the question. So what are we supposed to do in that case? So please see, on credit impaired assets, there can be a future expectation of further losses, and thus requirement of loss allowances. So how will this loss allowance be created? The loss allowance in this case will be created as change in expectations of repayment since change in expectation of repayments since the last year till here. So what do you expect to receive now? So basically change in present value of your expectations. So maybe, you can say since inception. So maybe in inception, you thought that you're going to receive just 10 million, but now your, expectations have improved. So it's like change in expectations. That's how you're going to treat your loss allowance. So we did a question in Super 20 on this as well, right? If you remember. So this is basically our loss allowance concept as a gist. Then we further have financial liabilities. So till now we were doing financial assets. Now we have financial liabilities. So financial liabilities, again, they are kept at fair value initially. Subsequently, two methods are available: amortized cost, which is basically the by default method. Then you have fair value through P&L. When do you choose for this? This was put in your mock as well for the students who gave my mock at TGP. This was tested in your mock 1. So fair value through P&L. Which method do we choose? When do we choose this method? When a liability is held for trading or to avoid an accounting mismatch. For example, you purchased an investment property, okay? So you keep an investment property under fair value through P&L. To buy that property, let's suppose you took a loan. So to avoid an accounting mismatch, you might end up actually, you know, even recording that liability under fair value through P&L. So that's what financial liability is, right? Then in this case, you're supposed to divide in fair value through P&L, divide the fair value movement. You're supposed to divide the fair value movement between what is happening because of your credit risk. So that movement will go via OCI and the rest of it will go via P&L. So you're supposed to see what is the fair value movement because of your credit risk and what is the fair value movement because of the rest of the factors. So the credit risk part will go via OCI and the rest of it will go via P&L. Then we also have a concept of convertible debentures here. So when you issue convertible debentures, there are two components that you're issuing. So initially, you're supposed to do split accounting. You have to split it between equity and financial liability. So how do you calculate the financial liability part? It is the present value of future cash payments to be made. And what discounting factor do you use? You use the discounting factor as interest rate of similar bonds without conversion rights. Without conversion rights, right? That's the discounting factor. Now, once you've calculated the financial liability component, you also take the equity component, and the equity component is proceeds minus the financial liability, right? That's how you treat the convertible debentures initially. Subsequently, the financial liability is treated under amortized cost and equity is kept as it is in the balance sheet of the entity. Very, very simple. Yes, we clear on this? This is what we have for financial assets and financial liabilities. Now, FR students can actually leave the class for like another 5 to 10 minutes until we start with the group accounts. Let us discuss derivatives. What do you have in derivatives? What are derivatives basically? So derivatives are just like something which has zero or very less initial value. That's what a derivative is, whose value is dependent on an underlying item, right? And then what else is there? What do you mean by a derivative? Zero or very less initial value, value is dependent on underlying item. It will be settled at a future date. That's what a derivative is. Now, how do you treat a derivative? Also, before I go to the treatment, one more thing. Derivative is held for speculation. Why will you enter into such a contract which will be settled at a future date and its value is variable? Because generally you want to speculate with it, you want to gamble with it, you don't buy it for your own business purpose. If you buy something for business purpose which looks like a derivative, it's usually a executory contract. So something which looks like derivative but is bought for business use slash delivery is usually executory contract, which is recorded in future only when it is executed, and it is not a derivative, right? Okay, now how to treat derivatives? So accounting treatment of derivatives. So we have to use simple fair value through P&L method if it is a favorable derivative. If it is a favorable derivative, then it is termed as a financial asset. If it is an unfavorable derivative, then it is termed as financial liability. Okay. Then we also have the concept of hedging here. What is hedging? Hedging is like, just a gist of it again. It's a betting against your own fears. You're like, okay, I am buying this so that I can net off the gain or loss on the hedged item. So there's a hedged item, and which is your basically a recognized asset or liability. Either it is an unrecognized firm commitment, or it is a highly probable future transaction. So now to hedge against it, you take a hedging instrument, which can be a derivative or a non-derivative, but usually a derivative only. Correct? So hedging instrument is there, right? Now, guys, this is termed as hedging only when the hedge is documented, formally documented. So you've basically documented the fact that this is my item, hedged item, this is my hedging instrument, and this is the purpose of hedge. And the hedge effectiveness criteria is met. Now, what do you mean by hedge effectiveness criteria? Hedge effectiveness criteria. The hedge effectiveness criteria is met only when the item and instrument have inverse economic relation. That means one will increase due to the change in the underlying factor and the other will decrease. Then only one will make a gain and another will make a loss to set it off and bring it back to net no gain, no loss situation. Right? So that's the first hedge effectiveness criteria. Second is the credit risk of the hedged item does not dominate the fair value changes of hedged item. Right? That's very important. And lastly, hedge ratio is appropriate. Hedge ratio is appropriate. So these are the three hedge effectiveness criteria, which if met, then only it could be hedging. And once the hedging rules apply, no other standard is applicable. Then there are two types of hedges. Number one is cash flow hedge. How do you treat the cash flow hedge? Effective portion goes to statement of other comprehensive income, and ineffective portion goes to statement of profit and loss. So basically you take your asset, your hedged item to fair value at the reporting date, and you also take your hedging instrument to its fair value at the reporting date. So the effective portion goes to OCI and ineffective goes to P&L. What is the ineffective portion? When the gain or loss on instrument is greater than the gain or loss on item. I taught you this particular concept in class with the example. If you remember the sibling example, so hedging instrument is the younger sibling and the hedged item is the elder sibling. So if the younger sibling is troubling you more than the elder sibling, then the parents say that this younger person is ineffective. We brought him to life for the entertainment of the first one, but the first one is very obedient and very kind and does not really, trouble us. But the second one keeps on troubling us. So that's basically ineffective portion, right? That's cash flow hedge. What do you have in fair value hedge? Again, you take the the item and the instrument to fair value. So the fair value changes go to statement of profit and loss, unless the hedged item is equity instrument kept under fair value through PN, fair value through OCI. That's it. So these are the topics under IFRS 9 overall that we have covered in just from a very technical yet important standard, that is financial instruments. Let me know in the chat box if we are clear on it. Yes, all clear. Hedging is there in Artright company. IFRS 9 is there in Carsoon company. The mocks that I gave you, it had a lot and lot of IFRS 9. Bhavya, if you purchase a credit impaired asset, it is simple. You record the interest income at CIAR, credit impairment adjusted rate. Art, right? Okay. Did you get a little bit of confidence on this area after this particular part? I hope you did get. Do let me know. No, Nilesh, you're mistaken. Now let us take again a small 5-minute break. It was too heavy on your mind, I'm sure, this particular standard. So let's take a small 5 minutes break. Okay. And we are going to resume with group accounts. So group accounts, we'll cover the basic group accounts, then we'll cover the complex advanced group accounts, then we'll do IS 19 and IFRS 2. I will not cover the certain small standards like IFRS 13, IS 37, IS 10, all these small standards like related party transactions, operating segments. I expect you to do it yourself. But yes, the major portions which I believe are like little complex as compared to others, I will cover them in the grand revision as usual. So let us take a small break. Yes, and resume with the class in the next 5 to 7 minutes. Yes, guys. Let us resume the session. I hope I'm audible to you. Let's begin with group accounts. Again, very important part of our syllabus, whether it is FR or whether it is SBR, because in FR it is tested for 20 marks. And even for SBR, it is for around 20 to 30 marks, right? You have a pre-populated question on group accounts. So let us discuss this topic in detail. So first we'll talk about basic group accounts. So in basic group accounts, FR students will also resonate to it. We are going to first talk about the definition of control, right? So what is control? That's our first question to be asked. So you can get a lot of, case studies related to this, that what is control. So control is basically, what is control? It's power over the investee, right? Power over investee, right over variable returns, right over variable returns, and ability to affect those returns. That's what I mean by to affect those returns. That's what I mean by control. Now, control can exist with 51% and above of the voting right. But can control exist even when the voting rights are lesser than 51%? The answer is yes, it can exist. In what circumstances it can exist? For example, majority of you can appoint majority of board of directors, or there is some kind of MOU between you and rest of the investors that you are going to vote on their behalf, okay? Or the rest of the investors are highly dispersed, and none of them owns more than like 10% or so. So they're very their holding is very less and highly dispersed, and they have very rarely come together and taken a decision. So in that situation, you could have control even when your shareholding is less than 51%. Okay. Now let's talk about the financial statements preparation. When there is control, there exists parent and subsidiary relationship, right? And in that situation, we are supposed to make the financial statements on the basis of consolidation. So let's talk about how to consolidate statement of financial position. So I have to make 5 working notes. Working note number 1. In this, I talk about group structure. So I have to identify who actually is the acquirer. So usually, guys, the acquirer is the person who is the bigger entity, who has issued shares or who has paid cash, who is going to have majority in the combined entity. So I have to identify who is the acquirer, right? So that's working note number 1. Then we have working note number 2, which is basically fair value of net assets of entity. So I'm going to take fair value of net assets of the subsidiary. So this is going to include share capital. This is going to include share premium, revaluation surplus, retained earnings, etc. Right? And there could be some fair value adjustments, which can also give rise to additional depreciation. So all this stuff, we look at it, the subsidiary's net assets at the acquisition date. So I check out the balances of these accounts at date of acquisition of subsidiary, and I check it at reporting date as well. So I do check it at the reporting date, and the difference between the both gives me post acquisition movement. So that gives me post-acquisition movement, which is actually shared between parent and NCI. So this is what basically is there in working note number 2, because IFRS 3 says that record the net assets of the entity in or subsidiary at fair value. Then what we have is working note number 3. So working note number 3 involves goodwill calculation, which could be full goodwill or partial goodwill. So partial goodwill is just allocated to the parent. So when we are impairing for SBR purpose, whenever we are impairing a partial goodwill, always remember to calculate total notional goodwill, right? That is grossed up goodwill. So I hope you remember that concept. So what is the formula of goodwill calculation? We take fair value of, okay, so we take fair value of consideration paid by the parent. Then we take fair value of consideration paid by NCI. Now, this consideration by the parent can be cash exchange. It can be share for share exchange. It can be contingent consideration, which is taken at expected value, or it can be deferred consideration, which is taken at present value, and a corresponding provision is created for the same. And since you take it at present value, make sure that you unwind the interest in working note number 5. So you add this up. Now, if it is full goodwill, see, if it is full goodwill, then only you will take fair value of NCI. Otherwise, you're going to take it as a proportion of working note number 2, that is net assets of the subsidiary at acquisition date. So you have to see whether it is full goodwill or whether it is partial goodwill. So you take that. From this, you deduct fair value of net assets of subsidiary at acquisition date. This gives you goodwill at acquisition date. From this, you deduct your impairment, right? You deduct the impairment of goodwill. That gives you goodwill at reporting date. That's your working note number 3. Then comes your working note number 4. Working note number 4, NCI. So you take NCI at acquisition. So if NCI was taken at fair value, that means if it was full goodwill, you'll take it at fair value. If it was partial, you'll take it as proportion of net assets. So NCI at acquisition, in that you add NCI's share in post-acquisition movement. So that comes from working note number 2, basically, right? Then you, from this, you deduct NCI's share of goodwill impairment if it was full goodwill, right? And if there's any other thing related to NCI, you're going to adjust it. This will give you NCI at reporting date. Then you have working note number 5, which is related to group retained earnings. So you take parents retained earnings at 100%. So parents retained earnings 100%. In that you add parents share in post acquisition movement of subsidiaries net assets, which again come from working note number 2, right? And if there is any additional depreciation, or if there's any parents share in impairment of goodwill, or if there's any unwinding of interest, right? That's what comes here. Or if there's any extra other expense, it comes here, and you get your group retained earnings. So these are the basic 5 working notes that we prepare for group balance sheet. How do you prepare your group P&L, group statement of P&L? See, in this, you're going to prorate the income and expenses of subsidiary and add up on line by line basis. So if your subsidiary was acquired 9 months into the years, So you are going to only record 9 by 12 of its income and expenses, right? Then you're also going to show share of parent and NCI in subsidiaries profit, correct? So this is how you prepare your group statement of P&L. Now comes intra-group transactions. Intra-group transactions. So see, guys, if there is a sale between parent, that means parent sold goods to, let's suppose the parent has sold goods to the subsidiary. So in that case, the journal entry to be recorded is group retained earnings debit and group inventory credit by the amount of PURP. What is PURP? Provision for unrealized profit. So PURP is calculated on inventory, which is still there in the warehouse. So basically, if parent has sold goods to the subsidiary, how many goods are still there of that intragroup transaction in the warehouse of subsidiary? On that, I calculate the PURP. Now, PURP can be given as a markup. So markup is always on cost, or it can be given as a margin, and margin is always on selling price, right? So that's what I'm supposed to see. Now, GRE debit, inventory credit, that's our first entry. Then we have when subsidiary is selling goods to the parent. When subsidiary is selling goods to the parent. So in this case, subsidiary's profit has to be reduced. So our working note number 2 will be debited. So basically, in just summarized way, your entry is NCI debit by its percentage of PURP, GRE debit by its percentage of PURP, and group inventory credit. Now to impact NCI, that is working note number 4 and working note number 5, the shortcut is to impact working note number 2, right? So this is what I do as my journal entries for intra-group transactions, which are the famous intra-group transactions. Now, how do you treat intra-group transactions in group P&L? In group P&L, you first remove intra-group sale from group revenue. Yes. And you remove intra-group sale from COGS, that is group purchases, and you add PURP. Lastly, you add PURP to COGS, because of course PURP is a profit that you want to remove. So to remove that profit, you need to add it to the cost. So add PURP to COGS. This is what you do in statement of profit and loss, and that's it. So this is the basic group accounts, which is relevant for both FR and SBR. And until here, the FR students, this is what your group accounts 20 marker question will be tested from. So you guys can consider leaving, because now I'm going to move to the advanced part of groups for SBR students, right? So this is until where FR students were supposed to listen. Now let's move on with advanced group accounts for all the SBR students here. Okay. Let's talk about the first topic, which is change in group structure. So change in group structure, we are basically, change in group structure is we are moving from a ladder. If you remember that meme of Tom going up to the heaven. So we are climbing up the ladder, right? And this is the golden door of control. Once you pass this golden door, you are acquiring the company and you're becoming a parent. So what are the situations here? See, if you have in any company, you have between 0 to 20%, this will be treated as normal investment, equity investment under IFRS 9. If in a company you have between 20 to 50% of shareholding, it will be treated as associate. Correct? As per IS 28, equity method of accounting. If it is above 50%, if something is above 50%, then it will be considered as subsidiary under IFRS 3. Now, there's a possibility that you move in the, or you enter the golden door of control in bits and pieces. So maybe you have 20% first, then 30, then 50, then 60. So there are certain situations which are termed as step acquisition. These are termed as step acquisition. So in step acquisition, we have scenario number one, where I move from no control to control. In this scenario, it is very simple. I need to first, step number one is calculate the fair value of previously held interest, right? And take it to fair value. Take the gain or loss via P&L. Derecognize the financial asset or associate. These are the only two options that might be there. And then record goodwill, calculate your goodwill. In that, please make sure that this fair value is included of associate or financial asset. So record goodwill and then start the consolidation process. So it's like you're saying bye-bye to the previous standard, which was there, and you're saying hello to IFRS 3. So that's the accounting rule for no control to control. Then comes the second situation when I'm moving from control to control. So in this, simply there is like IFRS 3 is still applicable. So we are not saying bye to any standard or hi to any new standard. So simply we are going to say this is an impact on NCI. So you previously had 60% shares. Now you basically have, let's assume, now you have 80%. So from 60%, you've moved on to 80% share. So your NCI has actually decreased. So this will lead to decrease in NCI. How will you calculate this? What will be the journal entry? Now to buy the company, money goes out. So NCI will decrease. So NCI debit, money is going out. So bank credit. And the balancing figure will go to other components of equity. Now, how will you calculate the decrease in NCI? How to calculate decrease in NCI? So you are going to use unitary method. So you will take what was the NCI at disposal date. So 40% of NCI at disposal date was X amount. 1% will be X divided by 40%, and we are supposed to calculate 20. So X by 40 into 20 will be the decrease. So that's the unitary method that you can use. Apart from that, if NCI, see, if NCI at disposal date is not given, then using unitary method is not possible. So how can you calculate? So how can you calculate in that situation? Then NCI can be taken as percentage of NCI into net assets of subsidiary, fair value of net assets of subsidiary at disposal date, plus if NCI also has a share in goodwill, that means it's a full goodwill, plus goodwill at disposal date. So you can do this in case of full goodwill method. If it is partial goodwill, then NCI into fair value of net assets of subsidiary at disposal date. So this is a workaround, or you've just found a general way that if NCI disposal date is directly not given, I can calculate NCI disposal date by using this formula. in case of full goodwill. If it is partial goodwill, I will not include goodwill in the formula, right? So this is what I will calculate, and this is the journal entry that will be passed. Very simple journal entry, right? NCI is decreasing, so NCI debit, money is going out, so bank credit, balancing figure to other components of equity. That is your step acquisition. Now come to the situation of step disposal. So scenario number one here is when you move from control to no control. So you have actually disposed the subsidiary. So when you dispose the subsidiary, one gain or loss on disposal is calculated in the individual accounts of the subsidiary and the parent, and one is calculated in group accounts. I'm talking about group accounts. So happy sad formula applies here. By selling the subsidiary, you receive proceeds, right? And you are happy to receive those proceeds, correct? So add it. Then when you sell a subsidiary, the NCI is going out. So NCI at disposal date is going out. Now you're going to lose that NCI. You're happy about it, so add it. Then if you are still on talking terms with your subsidiary, so there is still a retained interest. So fair value of retained interest in subsidiary is still there, because maybe you've lost the control, but maybe you're still an associate. So fair value of that retained interest, that is added because you're happy to have that interaction. From this, you deduct the fair value of net assets of subsidiary at disposal date, because you're sad to lose the net assets of a company. So you deduct it. Then from it, so you deduct this. You also deduct goodwill at disposal date, because of course you're sad to lose the goodwill as well. So this gives you profit or loss on disposal of a subsidiary. That's what goes via statement of profit and loss in group accounts. Yes. So this is a situation of control to no control. Then comes the second situation, which is very similar to the first part that we did, from control to control. This will lead to increase in NCI. How will you increase NCI? This time money is going to, when you sell a subsidiary, money comes in. So bank debit, NCI credit, other components of equity will be the balancing figure. Simple. So this is what we are going to do. That ends our change in group structure, right? Gist of it. Then come to the next portion. What is the next portion? Change in group structure is done. We have group foreign exchange. Group foreign exchange. So here basically IS 21 is applicable. So you first of all should know the difference between functional currency and presentational currency. So presentational currency is what in which you pay taxes. Functional currency depends upon primary and secondary factors. So functional currency is usually the currency of primary economic environment. So what are the primary factors for functional currency? Primary factors include in which direct costs are incurred, the currency in which selling price is quoted, then currency in which the direct costs are incurred, of course, then the currency in which our competitive forces operate. So competitive forces operate, right? Then what are the secondary factors? The secondary factors include the currency in which indirect costs are incurred, or the currency in which loans are taken, right? So that's what basically a functional currency is. So if a subsidiary is a foreign subsidiary, if it is a foreign subsidiary is a foreign company. See, first of all, I'm supposed to see whether the subsidiary is autonomous. Subsidiary is autonomous. That means it is independent from the parent? If no, then functional currency of parent is equal to functional currency of subsidiary. If yes, if subsidiary is autonomous, then apply primary and secondary factors. Primary and secondary factors that we have just discussed. Now, if parents' functional currency, is equal to subsidiaries functional currency, but there is a foreign transaction, then the foreign transaction is converted using spot rate as per IS 21, and if there is any closing balance related to that transaction in the balance sheet, and if it is a monetary item, we convert using closing rate. Monetary item is basically which is convertible into cash easily. And if it is non-monetary item, we keep it at historic rate only. So when you keep it at historic rate, there will be no exchange difference. But in the first case, there will be exchange difference. So that exchange difference will go via statement of profit and loss. Right? This is what was again tested in your mock exam number 1. Then if parent's functional currency is not equal to subsidiaries functional currency, then what we will do, all assets and liabilities of the subsidiary are retranslated using closing rate. All incomes and expenses are retranslated using average rate, right? This usually gives rise to a retranslation reserve, which goes by other comprehensive income. And that is never reclassified. So it is never reclassified, but only reclassified when subsidiary is sold. So it is reclassified only when subsidiary is sold. So this is the gist of group foreign currency. Then we also have a concept of group foreign or group cash flow, group statement of cash flow. So in this, basically, you have to keep, just keep in line with the fact that that when we acquire a subsidiary, we are supposed to take the cash inflows and outflows in case of acquisition or disposal of subsidiary at net amount. Net amount means how much cash did you pay to acquire a subsidiary versus what cash did it bring along. So I have to take the net amount of it. That's what you have to keep in mind. Secondly, you have to make sure that working capital movements are adjusted. So that was a quite technical thing. We did it in, again, Super 20 classes. So how is it adjusted, right? When the movement increases or decreases, that's what we discussed. So I'm not going into that. It will make it very long. So closing minus opening is equal to the movement. Usually when there's a, acquisition of a subsidiary, its results were not there in the opening balance, but they were there in the closing. So we adjust to the opening, right? So that's what we do. Then you also have to actually see what is the dividend paid / received. For that, you have to make various T-shaped accounts of NCI, of associate, right? So you have to make the T-shaped accounts to calculate this. So usually these are the special adjustments in group statement of cash flow, right? I hope you understand this. So again, this is a very wide topic, but there is very less theory to it. It's more like application based. So group cash flow is more like application based. Yes. Okay. Now, guys, try some questions on cash flow. Moise is there. This is for SPR. Moise is there. JoCat is there, right? So these are the two questions that you can try out for. I think Cabello company is also there. So just go through these company questions and you will be good to go. Plus, what I put up in the mock, you can try that as well. Okay, let's come to the standards IS 19 and IFRS 2. IS 19, employee benefits. Guys, in employee benefits, we are talking about various kinds of employees benefit, which can be post-employment benefits. Yes, which is basically for your like pensions. There can be long-term employee benefits. Yes. So, for example, the salaries that you pay. Then we also have short-term employee benefits, like you give them a car someday, right? So this is a short-term employee benefit. So let us discuss the pensions. There are defined benefit and defined contribution. I will discuss defined benefit with you. That's the most important and most tested part. So in defined benefit pension scheme, we have a pension obligation and a planned asset. So planned asset minus pension obligation gives us surplus, net surplus. So either there's a net deficit situation or there is a net surplus situation, right? So either there's a net deficit or net surplus situation. So I take that net deficit or surplus situation. So let's assume I'm taking deficit. In the deficit, the service cost component is added. Okay. Net interest is added. Service cost can be current or past, and even the plan amendment, settlement, curtailment happens to be in the service cost component only. And it goes via statement of profit and loss. Even the net interest goes via statement of profit and loss, right? Then contributions into the plant asset, contributions into plant asset. This is what is deducted from the deficit, okay? And benefits paid out have no impact. Benefits paid out have no impact on P&L, on SFP, or on cash flow. They have no impact, right? Then it gives you the closing deficit. You compare the closing deficit, which you get from the actuary, with the deficit that you were getting with this formula, right? So this gives you remeasurement component, which goes via OCI and which is never reclassified to P&L. Now, the only difference between long-term employee benefit and this pension plan defined contribution is that in long term, this remeasurement component goes via P&L, and in here, defined benefit, it goes via OCI. Then there's a concept of asset ceiling as well. In case of like surplus, sometimes you have to seal your surplus to a certain threshold. For that, you might have to bring down your surplus. To bring down your surplus, you record a loss in OCI. So when you bring down a surplus, it's a loss to you, and that loss is recorded in OCI as part of remeasurement component. That's it. This is what is there in gist in IS 19. Very easy standard, not difficult at all. But yes, certain TYUs, of course, are there for little nitty gritties. But as a concept, this is what is there. Then we have IFRS 2, share-based payment. This is basically when you make payments to your employees in terms of shares. So if you are making payments to your employees, okay, in terms of shares, it can be either equity settled share-based payment, or it can be cash settled share-based payment. That means either you're telling them that, I will give you share options, or I will give you share appreciation right. So in equity settled share-based payment, your entry is, in equity settled share-based payment, your entry is expense debit and equity credit. For surplus, it's totally the opposite, right? Okay. So for equity settled share-based payment, expense debit, equity credit. For cash settled share-based payment, it is expense debit, liability credit. For both IS 19 and IFRS 2, you can try, like for IFRS 2, you can try the question Margi from your exam kit. For IS 19, you guys can try the question. I think it's there in Lyra, as well as it's there in Hudson as well. So you can try these two questions. So cash settled share-based payment, this is the journal entry. Now, what is the formula for both? In equity settled share-based payments, we first have to estimate how many employees are supposed to meet the vesting conditions. So what are vesting conditions? See, I do not give them share options to my employees for free. I lay down certain conditions. Now, these can be market conditions or non-market conditions. Now, market conditions do not impact the calculations because they're already adjusted in the fair value of share option, which comes from Black-Scholes model. The non-market conditions, the performance-related condition, impact the number of employees who will get the share appreciation right. So yes, they do impact us, right? So that's what I have to do. Vesting conditions, market and non-market condition. Now, guys, if the vesting condition is like met for certain employees, how am I going to calculate my expense throughout the vesting period? So I'm going to calculate it via formula. I will take, number of employees. I will estimate how many number of employees are estimated to get the share appreciation or share options. So number of employees into number of share option each employee has into fair value of share option, at grant date. Okay. And this is like first year out of the three, let's suppose first year out of the three vesting periods. So 1/3. This is the formula that I use for equity settled share-based payment. For cash settled share-based payment, the formula used is number of employees expected to receive SARs into number of SAR each employee has, and then here you take fair value of share appreciation right at each reporting date. That's the only difference. So between equity and cash settled, this is the only difference. Okay. Here I take fair value of SAR at each reporting date, and here I take it at grant date only. Rest everything is same. Then in cash settled share-based payment, the cash is always paid at intrinsic value, right? Always remember this. And it is usually given to you in the question itself, right? So see, this is the gist of the two standards. There are further, nitty gritties in each of these. In every standard that I've covered, there are many other nitty gritties, many TYUs, many molds and concepts. But these are the gist of the standards which we can actually cover and discuss in a small session over a YouTube platform, right? I hope we are clear on this. And that ends our grand revision that I wanted to discuss with you today, where I've covered CF in detail, NCA in detail, IFRS 15, IFRS 16, and IFRS 9 in detail, group accounts in detail, IS 19 and IFRS 2 in detail as well. Yes, I hope we all are clear on this. So guys, this is what I wanted to do today with you. If you liked it, give it a thumbs up, give it a thumbs up on the video. And once the session is over from my side, this recording will be available on YouTube, and you guys can actually rewatch it. And I will attach the notes in the description box. So stay connected, guys, over the free WhatsApp groups. And I really hope and I pray that all the students who were here today and who all watch this later on, you guys are helped with this video and you all really pass with flying colors. So all the very best to each one of you. May God bless you. We are really towards the end of our preparation, and I sincerely wish and pray that you guys really pass with good marks this time. So all the very best. Sending you all the positive vibes. If you would have any doubt, do comment down on this video, and if it video helped, please do let me know in the comment box later on. So all the best, keep studying, share this important resource with your near dear ones and your peers who are studying for SBR or FR. So goodbye guys, take care, bye bye, and thanks for all the participation that you guys have taken. It was a great session with all of you, and congratulations to all those who survived till the end. Yes, proud of you. Goodbye.